Right. So let's move on to the next issue. We saw a bit of this when we were looking at, I think it was a painting that someone had. Was it a painting? I think it was the use of. I think it was insurance. I think it was a question on insurance where something had broken and something, and the insurance company gave us money, and we took that money and reinvested it back into the new asset, thus changing the base cost of the new asset and deferring the gain. Exactly the same principle, which is why I'm saying that we see these principles reoccurring. So let's see exactly what's happening here. Like all things, you have all this theory, and using examples help. Key point here is as long as we use the proceeds we get, because you can see the issue here is that it's a bit, if you cannot, especially in business, if you sell an asset and you make a gain, you're probably doing that to buy a new asset, and it's a bit unfair to pay if you don't have the money, or the business might stop, so we can defer, so we can roll over that gain. So the gain arising, this replacement of business asset relief allows the gain arising on the disposal of a qualifying business asset, where this is reinvested in a new qualifying business asset. So really, again, the aim here is to really be dealing with, both old and replacement assets, assets that are usable with regards to the generation of funding in the business, or money in the business, or the day-to-day running of the business. So land and buildings, fixed plant and machinery. That's where we're really going here. Goodwill as well, of course, so for unincorporated businesses as well. Shares are not qualifying assets, so we're really talking about hard core, on the ground assets, machinery type manufacturing to encourage businesses. Now, I might have mentioned this idea some time ago about the 1 to 4 year rule, where I was highlighting that. So it doesn't really matter. I mean, think about it. You could have made a purchase here, but made a sale here, and we can roll over the gain from the sale here into the purchase here. I mean, this is all. We're just trying to kind of, because as you can imagine in a real business, when you start procuring and buying and selling these assets, you have a plan. You want to sell something and then buy something else. Now, the sale might go through before the purchase of the next one. The purchase of the new product might come out just before the sale of the old one. So we still want to be able to map them. We're not trying to be hard and fast about this. So the replacement asset must be purchased 1 year before, or at least 3 years after the date of sale. That one makes a bit more sense, because the 3 years is more like, well, we've sold this first one now and we're buying this new asset. It's taken us 3 years to actually get it right. We could have bought it just before, because the sale was going to take longer for whatever reason. There was an issue. So that's the thing you need to be, also maybe for Section A, you need to be aware of, but you'll see what I do questions. Okay, great. So let's go into let's see, what are we saying? So really, again, nothing crazy. The gain is deferred by deducting the deferred gain against the disposal of the new old asset from the acquisition of the new asset. And we could keep rolling this on, but all you're doing is deferring the gain. You're not escaping. On final sale, that gain will crystallize on the disposal of the replacement, on the disposal of the replacement asset. Right. So, what we're dealing with here, let's look at this question here. So Diana buys a factory. I'm just going to go through the theory so you can see what's going on, and then we'll look at the numbers. Diana buys a factory June 2003 for $250,000. She adds an extension to the thing, and so that's capital for $190,000. Right. And so we have here a total cost. Right, I don't know why I dropped my calculator somewhere. I'm doing this all in my head. I'm going to have to go and get my calculator. 5 plus 9 is 14, and so we have here a cost of 440. So what does she do? And then it says she sells it for 989. So our first job is to calculate the gain. Let's get the gain and understand what we're going to do with this gain. So 989 minus 440,000, you will have a gain of 549,000. That's your gain. This is your gain. Now, the next thing we need to do is ask the question, how much did we get for this thing? We got 989. It says that you go along and you buy another factory for 1,130. So you have spent, and even more. So you've definitely spent all of the proceeds that you received. So therefore, this gain, so that's the test. How much of my proceeds have I spent? All of it? Well, definitely I can defer all the gain. So it's almost like I literally didn't make it. Well, you're just rolling over the gain. So we can roll over this gain. What does that mean? This new asset cost you 1.13 million, right? And now you can roll over that gain. So instead of recognizing a base cost of 1.13 million, I will deduct 549 from this thing, giving me 581,000. It's okay because, again, these are the type of you can see the other issue here is that these are things that continue to appreciate in value. I know I'm going to be able to. It's a factory, right? It's a factory. It's not like some chattel type machine. We can see here fixed plant and machinery. The idea is these things continue to appreciate in value. It's not movable. It's not like chattel where these things are movable and they depreciate. No. So we know that this thing will go up in value possibly because again it's a factory. So later on in the future, when you sell it, this will be the base cost. Imagine I sell this thing for 1.2 million in next year. I mean, that's the base cost, and that gain of 549 is in here. It crystallizes, it comes out. So it's not the end of the world. It's actually quite a good way to do things. So this is how we deal with this. This is what's referred to as rollover relief. Then it says here that what actually happened was you went along and you then sell this thing for 2.34 million a number of years later. So there we are, base cost of 581. You go and sell it for 2340000. You sell it for 581,000, and therefore you make a chargeable gain of 1759000. Right, so that's your chargeable gain. So you have the new gain and the old gain both in this place. Now I think I have some time on the video. Let me go. No, yeah, 15 minutes. Let's go on to the next one. That was because I used all my proceeds, right? Nothing different to when we talked about insurance. You must use all your proceeds. This is the issue. And the extent to which you do not use all your proceeds determines the extent of the gain that can be rolled over, right? Because whatever of your proceeds you don't use becomes realizable and chargeable straight away. So let's see what that means in this question here in example 7. So we have here that Elisa sells an office block which was always used for the purposes of her trade in September for 975. So what we have here, Elisa, let me just 975. And she bought the thing for 569,000. So we have a gain of 406,000. That's the gain. This is the gain. The question here is, are we going to be able to defer this gain? That's the question. That's the real issue, isn't it? So the question is, are we going to be able to defer this gain? We now need to ask the question, well, how much of these proceeds, so I'm trying to get the logic, make sure you're happy with the logic. How much of these proceeds did she use in buying the new machine? So it says here, let's look at A, that she spends 910,000. So if she spent 910,000, that means that she didn't spend, I'll use a red color, 65,000. This is chargeable straight away, right? Proceeds not reinvested. This is chargeable straight away. That's chargeable straight away. You know, she's kept that money, so of that gain. So she's got the money from that gain, so that's chargeable straight away. Now, what that does mean is that well, the rest of the gain, 65,000 of this gain is chargeable straight away, but the other, so 406,000 minus 65,000 is deferrable. So if I deduct 406 minus 65, I get 300 and let's just do that. 0, 0, 0, 1, and then I have 9, 300 and 90. 1 second, let me just see what I have here. Sorry, I can't add anymore nowadays. 406 minus 6 minus 5 is 1. 10 minus 6 is 4, so that's 341. So that's 341. So 341 I can roll over, right, into the new asset. That's my new asset, 910 minus 341,000, which takes me into the realms of 569,000. So my base cost is now 569,000. So what am I saying? Find the difference, 975, 569, find the original gain, ask the question whether all the proceeds have been used. The extent to which the proceeds have not been used will determine the extent of the gain we can roll over. We haven't used 65, so that means that 65 of this gain of 406 is crystallized straight away, and therefore we can only roll over the bit of the gain that hasn't crystallized. Let's look at the next one. It's the exact same scenario. I have a 406,000 gain. Now the question here is that you made 975,000. You've only used 500. I'm doing B now. 515,000 of that. So that means that you have kept behind 0, 0, 0, 0, 6. You have kept behind 460. So wow, so that's so much more than the actual gain. So all of this you have kept behind 460. So it means this exceeds even the gain in question. So definitely all of the gain, 400. This is the gain here, 406,000. The question here is, this is the gain we're interested in. All I'm just trying to do here is, this is what is chargeable. I'm just trying to question whether or not you can roll it if you're buying something else and you're going ahead to buy something else. So this 515 in itself has nothing to do with the gain itself. It just is, are we spending? How much of it have we spent? So you've spent only 515 of it, a difference of 460. And so in effect, you haven't spent, you didn't need all of this gain. You've pretty much kept all the profits from this gain. So all of that gain is chargeable. So the chargeable gain in this case here is everything, 406,000, if you like. And the base cost is just what it is, 515. That's fine. So you've literally this is actually a very normal process. This is how things used to be once upon a time. You sold an asset, you made a gain of 406, you pay your tax on it, you spend some money, and you buy another. Right, so you don't get any rollover. You don't get any rollover relief at all on B. Right, good. So that's that one. Let me see. We might take a yes. It is coming up to I think. Right, good. So I think what we'll do is we'll stop there, and I'll see you in the next video where we discuss scenarios where because remember, this rollover relief thing is very much a business relief. As opposed to taking advantage of it, especially when assets have been used for non-business purposes. See you in the next video.